Find out how retail, hospitality, and leisure rate relief works during 2026-27 and which Milton Keynes businesses may qualify.
In April 2026, independent retail and hospitality operators across Milton Keynes will tear open their annual business rates bills, expecting a measure of financial relief. The government spent months heavily publicizing a permanent tax cut for the retail, hospitality, and leisure sectors, promising lower multipliers to support the high street. But instead of a reduction, thousands of these business owners will look at the bottom line and see that their final cash liability has surged. This discrepancy exists because the 2025-26 tax year featured a 40% discretionary discount. For 2026-27, that discount is gone, replaced entirely by a strict new statutory framework. Relying solely on political headlines about tax cuts, without mapping the exact mathematical impact on your specific property, leaves owners exposed to immediate cash flow deficits. I'm speaking on behalf of Atlas Tax Advisors, specializing in tax planning and HMRC compliance. We are focusing this analysis specifically on small and medium enterprise directors operating physical retail, hospitality, or leisure premises strictly within Milton Keynes. While these legislative updates affect commercial landlords and contractors across the board, our priority today is measuring the direct cash flow impact on the physical occupier. The transition from the old 2 multiplier system to a new 5 multiplier system rewrites local commercial tax liabilities from the ground up. Navigating this overhaul requires understanding how Milton Keynes City Council applies these new rules, calculating the hidden arithmetic, and recognizing strict new compliance criteria. The Non-Domestic Rating Act of 2025 serves as the legislative vehicle for this shift. It permanently abolishes the previous retail, hospitality, and leisure discount, which had been capped at £110,000. This diagram outlines the new structure. Properties under £51,000 use the Small Business RHL multiplier at 38.2 pence. The next tier, up to £499,999, uses the Standard RHL multiplier at 43 pence. Both provide an exact 5 pence discount compared to standard businesses. The government has balanced this reduction for the high street by shifting the tax burden directly onto massive corporate operations and distribution warehouses. To fund the lower tiers, a punitive high-value multiplier of 50.8 pence is applied uniformly to any property with a rateable value of £500,000 or above, regardless of its industry. While this structure shields independent shops and heavily taxes online fulfillment centers, the baseline math contains a hidden trap for the smallest operators. Consider an independent café operating in Milton Keynes with a baseline rateable value of £15,000. On the left, the 2025-26 calculation applies the old multiplier. Factoring in the abolished 40% relief drops the effective rate to 29.94 pence. For 2026-27 on the right, applying the new 38.2 pence multiplier without that discount makes the final cash liability substantially higher. By transitioning from a temporary discount to a permanent statutory rate, this small business absorbs an effective nominal tax rate increase of 27.6%. Many business directors read headlines about permanent tax cuts and fail to factor in the total loss of those temporary relief caps. If you do not account for this 27.6% effective hike in your financial planning, your enterprise risks a severe cash flow shortage in the first quarter of the new tax year. To mitigate sudden spikes in rate liabilities following revaluations, the government uses transitional relief as its primary safety net. For those losing their prior small business or rural rate reliefs, the Supporting Small Business Scheme provides a secondary layer of protection. This scheme enforces a hard cap. It limits year-on-year bill increases to the higher of either £800 or the relevant transitional relief percentage cap, which is 5% for small properties. Alongside these general caps, a specialized sector bonus exists. In 2026-27, eligible pubs and live music venues receive a distinct 15% rate relief. The arithmetic for this bonus follows a strict sequence. The 15% is calculated daily and must be applied after mandatory and transitional reliefs are factored in, but before any local discretionary reliefs. Calculating your 2026 overhead costs accurately requires running your rateable value through this exact sequence of reliefs. Milton Keynes City Council uses automated database analysis of public records to assign these new multipliers before the March billing cycle begins. This automated approach creates a severe compliance hurdle for mixed-use properties, such as an e-commerce warehouse operating a small public showroom, or a production brewery with an attached taproom. To legally qualify for the lower multiplier, the property must pass a rigid statutory test, proving it is wholly or mainly accessible to the public. The council audits this ratio by examining the proportion of public floor space against private operations, or weighing direct in-person turnover against online sales revenue. If your property classification is ambiguous, you must submit manual portal applications and provide hard evidence, including detailed floor plans and turnover records. Failing the wholly or mainly test defaults your business to the higher non-retail multiplier, stripping away margins and inflating your operating costs. Beyond the statutory national rates, Milton Keynes City Council utilizes localism powers to enforce its own discretionary rate relief guidelines. Registered charities automatically receive an 80% mandatory relief, but the council retains the authority to grant an additional 20% local top-up. Securing this top-up demands rigorous compliance. Organizations are required to submit fully audited financial accounts and detailed business plans for review. The council will refuse applications if they determine the occupation serves as a rates avoidance scheme, or if the organization fails to provide a unique, measurable benefit to the local Milton Keynes community. Whether you are seeking a national retail multiplier or a local discretionary top-up, the burden of comprehensive financial proof rests entirely on you, the ratepayer. The 2026-27 financial year forces businesses to navigate a 5 multiplier structural shift, absorb hidden tax increases, and pass strict classification tests. Business owners, landlords, and commercial startups must update their cash flow forecasts immediately to reflect these higher statutory liabilities. Please note, this breakdown is for educational purposes only. It does not constitute formal legal or tax advice, as individual circumstances and property valuations vary. If you are struggling to map your liabilities within the new multiplier matrix, or if you face a classification dispute with the council, seek professional intervention. Atlas Tax Advisors specializes in securing supporting small business relief, compiling compliance evidence, and shielding your commercial cash flow. You can reach our team directly at 07404-427-275 via email or by visiting our website to schedule a consultation. Subscribe to our channel to stay ahead of ongoing HMRC changes and ensure your commercial operations in Milton Keynes remain secure.